The stock market. There are lines that go up and lines that go down. But why do they do this, and how does the stock market even work? Today, we're going to find out. Before we talk about the stock market, what is a stock? A stock, or a share, is an asset that represents ownership in a company, which includes what the company itself owns and the profit it generates. If you buy one Apple stock, you own part of the Apple company. However, there are 16 billion other Apple shares owned by other people and companies. So why do these Fortune 500 companies let anyone own part of their company? These companies are selling ownership of their company, in exchange for the large amount of cash that they can raise almost immediately. This amount of revenue generation is much larger than any loan that they could get conventionally. They want that huge surge of money so they can keep developing, researching, and growing. Employees, materials, and resources are all very expensive, and it takes longer for companies to grow if they have to generate all that money in profits. This access to large amounts of money up front allows startups to compete with the established companies that have been around for a lot longer. An entrepreneur will often initially fund a company with their own money or money they get from independent investors. Once the company gets established in the marketplace, they can file for an IPO, or initial public offering. An IPO is often where the initial investors cash out after investing potentially millions of their own dollars. After the IPO, the private company turns into a public company, and anyone with the money can buy shares in the company. This also means that the company is listed on the stock exchange. Stock exchanges are third-party services that connect investors to the shares of the company, without the actual company being involved. This means that when you buy a stock, you're not buying it from the company, but rather someone else who is selling the stock. Similarly, when you sell a stock, you're selling it to another person, you're not selling it back to the company. Historically, stock exchanges used to be a lot more difficult to get to than they are now. In the 1700s, investors would just meet underneath a tree that was on Wall Street and trade stocks. This changed in 1792, when the New York Stock Exchange opened, which you had to physically go to, in order to buy and sell stocks. The Internet has linked investors to stock exchanges from anywhere, and commission-free trading has removed the $7 to $10 cost per trade that was the standard for most of the 90s and 2000s. You often needed a middleman, or stockbroker, to make this trade for you, regardless of whether you were buying or selling. The price of the stock goes up and down based on many different factors, including supply and demand, speculation, economic reports, news about the company, among many other factors. We will cover advanced stock analysis in a future video. Many people who don't understand the stock market see it as a gamble. They see all the millionaires that have been made from Bitcoin, Dogecoin, Apple, and Amazon stocks. In reality, these are very rare, and almost impossible to predict. A large amount of luck goes into succeeding on these moonshot stocks. The secret to true power in the stock market is diversification. Putting all your money into one stock maximizes your risk, because if that stock goes down, so does all of your money. The most popular way to diversify your stocks is to purchase an index fund, like the S&P 500. When you invest in an index fund like this, you are investing in 500 companies at the same time, without needing to buy each of them individually. This way, if 1, 10, or even 100 of your company's stocks drop in price, you have the rest of them to keep your money stable. Before you go and buy your first stocks, do your research, and don't focus on just the Fortune 500 companies that you love already. The biggest movers are usually small companies that grow, like how Tesla, Amazon, and Apple were all much smaller companies 20 years ago. And above all else, consult a professional financial advisor. I am not a financial advisor, and this video is not financial advice. Stay safe out there in the stock market and remember to do your research and limit your risk. I hope you enjoyed this video. Let me know in the comments if there are any topics that you would like me to cover in future videos.